convenes during the year to discuss the nation's economic outlook and develop a consensus forecast. Following today's presentation, we'll have a Q&A session. Also, a reminder that this virtual press conference is being recorded and will be posted at aba.com if you want to see a replay. ABA is very fortunate that some of the world's top economists work at our member banks and volunteer to serve on our Economic Advisory Committee. Their forecast is shared with our member banks across the country, including the many smaller institutions that do not have their own economic teams. The committee also shares its insights with the Federal Reserve and with the public through today's press release and this virtual press conference. The timing of this latest forecast comes as the new administration pursues a host of major policy changes on everything from trade and taxes to regulation and the size of the federal workforce. Our chair is ready to share the committee's assessment moving forward. When he isn't volunteering his time to ABA and leading the committee, Luke Tilley serves as EVP and Chief Economist at M&T Bank subsidiary, Wilmington Trust. Luke, thank you again for serving as chair of the EAC and for overseeing the good work of the committee. We look forward to hearing more about the committee's forecast. The virtual floor is yours.
Thank you very much, Mike. Thank you to the ABA for holding the press conference here and then also for hosting us in the group. We really enjoy the ability to get together and have the economists from the banks across the country to talk about the issues of the day. But more importantly, thank all of you for joining us here to hear about the forecast. So I've been on the group for 2.5, maybe 3 years and been the chair for the past couple of meetings. And this was a unique gathering in terms of my experiences of past, of course, because the policy environment is changing so much. I mean, literally, as we were sitting over the course of the past couple of days and working through the impacts of policy changes that could come about, working through our forecasts, which we had all submitted last week, and then trying to adapt to the changing policy. And I think that's really the overriding sort of undertone of the meeting is that, as I'll talk about in a moment, we have our forecasts, but the group agreed that the what we think of as confidence bands or error bands, your level of certainty that your forecast is right, that certainty has gone down, or the error bands have widened. It could be a lot higher or a lot lower. And it comes back to that policy uncertainty, which is not to say that the policy is bad or good. It's just that when there is uncertainty, at least for us mechanically, we don't know what to plug in, so to speak. Do you assume that the tariffs stay on until the end of the year? Do you assume that new ones are coming? What do you assume for the government workforce? And so I would again just say that the overall message is that we do see a fairly strong economy, and then trying to figure out which direction it's going to go is a challenging exercise. That said, I hope you have the materials, sort of the summary forecast, which shows the median values for the economists who participated in the forecast. And what you'll see is that we're expecting roughly trend growth, or a little bit higher than trend growth, for the U.S. economy in 2025 and 2026. So that's 2.1%. And that's a little bit of a slowdown from the past couple of years, expecting a little bit of a slowdown in personal consumption, a little bit of a slowdown for some of the CapEx categories and residential building. But I think it's still a fairly strong economy in terms of the baseline forecast. The other main item that I would note is that the central forecast, so that median forecast for inflation, is for it to remain a little bit above the Fed's target, the 2.5% quarter four, year over year, quarter four at the end of this year. And then essentially the same, but just down another 10 basis points, 2.4% next year. So that's the PCE measure of inflation. That's the Fed's preferred gauge. And that would be above their target. And so what that translates to is the central view on the committee was that you would not see too many rate changes from the Fed. It would be just 50 basis points in 2025, another 50 basis points down, I should say, cuts in 2025, and then another 50 basis points down in 2026. But also a lot of variation around those forecasts. I mean, some people on the committee expecting no more cuts, none in 2025. A couple people on the committee expecting 3 or 4 in 2025. And I would say, again, that comes back to the uncertainty of both the scale, scope, and duration of the tariffs that have already been put in place, what their impacts would be on inflation and on the consumer, and a lot of that uncertainty. So I'll just say again before opening it up to see what all of you would like to talk about, that the committee sees a fundamentally strong economy with a lot of uncertainty going forward. So I'll open it up for questions, Mike.
Yeah, thank you, Luke. Like Luke said, at this time, we're going to open it up for questions. If you'd like to ask a question, please either use the raise hand feature or put a note in the chat, and we'll call on you. And if you're not asking a question, we just ask that you please keep your line muted. Please identify yourself and your media outlet, and try to start it off by limiting yourself to one question at a time so we can make sure that we get to as many different people as possible. And with that, we'll open it up for the first question. Anybody? I don't see any hands or chats or anything.
Hello.
Go ahead, Hake.
Oh, there you go.
Hi, sorry, I couldn't find the raise hand feature. Luke, thank you for the presentation. I have a question on inflation and tariffs. I'm just trying to get your sense. At the last meeting, a lot of the measures that Trump was previewing were just promises. Now we have specific numbers, specific targets, and I'm trying to understand, in your view, how we should think of potential inflationary effects from tariffs on so many fronts. Is this a one-time adjustment that will over time, disappear, or is it going to be closer to the 2021 episode where supply chain disruptions kind of caused a permanently high or lasting high level of inflation?
Oh, yeah, that's a great question, Hake. And I will try to summarize the way that the committee talked about, because different people had different views on this. I think roughly everybody would agree that there is an inflationary impact of the tariffs, at least in the short term over the first couple of months, as prices go up on imported goods, and that would cause an increase in a lot of the prices, of things that are imported, and those can become capital goods and consumer goods, and those would flow through and show up as inflation in either those items in the CPI index and the PCE. Nobody on the committee had a forecast or an expectation that it would be, as you asked, like the 2021 episode or something like that. And that is fundamentally because of the relative strength of the consumer. So right now, I don't think anybody on the committee saw the consumer as strong enough to afford those kind of price increases. What we had in the previous episode, 2021 and 2022, was a time where people had a lot of savings from not going out during the pandemic and not spending on services. And then, of course, a lot of government stimulus. And they could afford price increases across the board. So for most people on the committee, it comes back to that question of how strong the consumer is. And for those who thought the consumer, relatively could handle it, I think the sort of the more, I'm going to say pessimistic, but I think the pessimistic view would be the largest impact on inflation that I saw within the committee was inflation moving up in the PCE up to around 3% this year. That's not something that we publish, sort of the individual responses, but I can remember hearing as high as 3% and bringing growth down below 2%. Sometimes people will characterize that as a stagflation scenario. That's not really stagflation in my mind, like we had in the 70s or 80s, but to give some idea of that increase in prices. So 3%, obviously a far cry from what we experienced in 2021 for the people who plugged in the most amount of inflation hike. I think for people at the other end of the spectrum that would expect weaker inflation, it would come from essentially demand destruction. So there were a few people on the committee who did not think that even though you would see higher prices for those imported goods in the short term, the first few months, let's say, that consumers are not in a position to shoulder those increases. So you would see a lot less spending on services because of the higher price of imported goods. You'd see a lot less spending on those imported goods too, and it would actually end up being deflationary in the longer term because of those growth impacts. And we did discuss the fact that over the course of the week, the Fed funds futures market actually kind of priced that in to some degree by increasing the number of Fed cuts. Like, oh, there are tariffs. And a lot of these announcements were coming as we were sitting and talking through the week. Okay, there's a new tariff announcement, and that would increase the chances of the Fed cutting rates. And that sort of would go to that second story. As I said, not very many people were putting in their baseline forecast. So we have the inflation forecast here of 2.5% in PCE for the year. Not very, I think only one person on the committee out of the 16 was plugging in tariffs for the rest of the year. And that would have been some of those higher inflation numbers. And then also between those two groups that I said, I think the majority were on the higher inflation side relative to the second description that I said, that it would end up leading to lower inflation. But it really comes down to what you assume for the duration of the tariffs. And in any case, I'll just say again, nobody voiced an opinion that it would end up like it was in 2021.
Thank you.
Thank you.
Hello, can you hear me?
I can.
Oh, hi. I also didn't see the raised hand feature. Anyway, this is Susan Wood from the North Bay Business Journal in Northern California. Couple things, Luke. Please don't get me wrong on this, but as far as the overall view of what looks like a strong economy, some might say we look like we're in a state of chaos. And I mean, to have the Wall Street Journal come out with a Trump session headline seems a little disturbing. How do we account for what it looks like? You're saying is, yes, we're going to see an impact from the uncertainty related to tariffs, but then it sounds like you're saying it's going to level off. Is that correct?
So great questions, Susan. And nobody in the room was using the word chaos. We were talking about the sheer level of uncertainty. I mean, as we were sitting there for the 2 days, tariffs coming on and then going off, and going on for one country, coming off for another. And I think that as we were sort of grappling with that, the main message was, we don't know what to assume. So the tail end of your question is a great one. I mean, you were saying, does our committee expect that the impact would level off? We don't know, because we don't know exactly what to plug in. Again, there was I think only one person on the committee who said these tariffs are going to be put on and then assume that they stay on through the end of the year. Everybody else had some different formulation. In terms of the impacts, so that would be sort of what's the impact of the tariffs, whether they were going on or coming off. And if you knew that with certainty, everybody could plug it in. The question that you're asking about, what are the impacts of uncertainty, was a major source of discussion. One of the committee members pointing to a research paper done, I think, by Federal Reserve economists, or a group of economists, some were from the Federal Reserve, from 2018, not written in 2018, but examining the impacts of uncertainty from the 2018 experience and noting that research paper and a couple of other ones would say, an estimated drag on GDP from the sheer uncertainty. And that is something that I think most people on the group as economists would agree with that notion without even being able to put a number on it. But we talked about the fact that any measure of uncertainty, trade uncertainty, or policy uncertainty is very elevated right now. And that makes it challenging for consumers and businesses to operate. Again, this is not saying whether the policy is good, bad, or indifferent, but recognizing that if a business is not sure what policies are going to come or what tariffs or what tax rates are going to be coming down the pike, then it's much harder to make a capital investment that has a multi-year stream of profits that you're trying to make. And so that can really have a big impact. This is not a committee discussion, but I personally have been talking to clients, M&T clients and Wilmington Trust clients over the past couple of weeks. And you can hear that from individuals who would say, why would I buy materials right now that would need to be imported if I buy them this month, if there's the chance that next month they would be 25% cheaper with the tariffs coming off. So, the thrust of your question is about the impacts of uncertainty. And I would say that the best way to summarize what the committee discussed was it has just the uncertainty by itself has a downward impact on growth, that it does detract from growth. It's a very hard thing to measure, and everybody sort of had to roll it into their forecasts. And that leads to a lot of the overall uncertainty that we have about our forecasts. But on net, the level of uncertainty and not knowing what policy is coming, we expected would have some drag on consumer spending and on CapEx, Susan.
And just as a follow-up, because I'm very geocentric, North Bay Business Journal. So I'm thinking of the wine industry, for example. Aren't there going to be major impacts on business? It's not only individual consumers, but you've got items like wine bottles, where wineries get their bottles from Mexico. So wouldn't that have a delayed reaction? So their problems, wouldn't that create a delayed reaction at the banks because they're doing business with the banks?
So putting aside the question about banks and then just first thinking about businesses, we did talk about a lot of individual businesses and industries, not so much wine, except for the, I think, well-reported fact that Canada imports a lot of U.S. liquors and wines. But the cost that you mentioned, the cost of a bottle, if that's something that you import, is definitely a major part of the discussion around the table as we try and figure out what is the inflation impact or what is the price impact, of course, because any importer, including a winery that is importing bottles, can make a decision about the higher cost of that import. They can try to handle it themselves, and take it on the profit margin. They can try and push it through to the consumer, or find some other way of managing that or dealing with that. And I think the opinion of the committee was that there's some evidence that, at least in 2018 and broadly, that tariffs in the most recent experience in most years, that tariffs have been passed ultimately to the consumer. Doesn't mean that it would happen now because of the relative strength of the consumer. But most people were factoring in, I think, that costs would be passed on to the consumer, and that would get to the sort of the inflation numbers that I was talking about before when Hake asked his question, with differing experiences. So we didn't dig into the second part of your question, is what would be the impacts on the banks that are dealing with those customers. We did touch on generally the banking environment with some of the uncertainty. that is sort of an unknowable thing of how credit availability would change. We do have estimates of that on one of the pages here. I think it's page 3 out of 4. But consumer credit availability, at least with our central forecast, 8 respondents saying it wouldn't change, it would stay the same. One person saying they expect it to improve over the next 6 months. One person say deteriorate. Business credit availability, a little bit of a different experience. You got more people in the improve and the deteriorate, but it's still pretty balanced. Again, these submissions were made before the tariff discussion this week, and then I'd say that the discussion about banking or any particular industry was that it would be the impact in the short term would be to the downside. But again, coming back to not knowing how long these things would stay in place, Susan.
And forgive me, I knew these.
Susan, this is Jeff. Sorry, we do have to just try to get other folks in, but we might be able to come back to you if there's time.
Oh, right. I got it.
Thank you, Susan.
Any others have any questions? And if it's difficult with the hand raising feature, feel free to unmute yourself and ask the question. Anyone else?
Yes, I'd like to ask a question. My name is Leslie Cook from money.com, and I don't know if this was addressed during I haven't had a chance to see the press release, the preview of the press release that was sent. I know it was sent, but do you see this uncertainty that we have been talking about having an impact on consumer credit and in particular on the housing industry, be it for loans to builders for buildings or consumers who might be interested in doing some home buying?
So excellent question. And there are a lot of different sort of like parts to this. Consumer credit availability, I should say, again, just the general question of consumer credit availability, Leslie, that we asked about beforehand was that it would roughly stay the same. And again, this was before sort of the events and the uncertainty. Even going into the meeting, the question about consumer credit quality, so basically performance, was that there were 0 respondents who said that they thought consumer credit quality was going to improve. 5 respondents said they expected to stay the same, and 5 expected it to deteriorate. So that is a recognition that what we've seen in the economy, even before this uncertainty, is that we've seen credit deterioration. We discussed that quite a bit at the committee because you've got the rising delinquency rates for credit cards, autos, to some degree in mortgages, though mortgages is less pronounced. But that overall idea that the ability for people to keep up with payments has been deteriorating for more than a year, and we continue to see those delinquencies rise. Now, a lot of that is in subprime. It really is in lower income and lower credit scores, while the upper income and higher credit scores tend to be still performing better. In terms of the impacts of uncertainty, we really didn't get into too much of drawing a direct line from uncertainty to making credit available, or what would happen to the home building industry, home buying industry. That sort of an impact would just come through, I think, the overall macroeconomic impact. So if people, it would be basically through interest rates and sort of overall demand and overall economic strength, if you will. And our baseline forecast is for that strength, the 2.1% GDP growth and somewhat higher inflation. The expectation of the Fed not really cutting rates, and I'm sorry, I'm going to flip over to we do have an expectation for the 30-year fixed mortgage rate, and it's for not that much of a decline, for 7%, and then going down about 30 basis points through this year. So that would provide some help in the baseline forecast for people who are looking for a home, but that's obviously still kind of a high mortgage rate relative to years past, and still very low supply of homes on the market in the resale market because so many people have that low mortgage rate. And I didn't hear anybody on the committee really voice an opinion that was going to change. When we layer in the uncertainty and sort of some of those possible drags on economic growth from tariffs, then there is the expectation that you would have less of that kind of activity, less home buying, because you're also talking about lower job growth, lower consumer demand, lower real incomes. But again, that is not directly from the uncertainty. That would be from the overall macroeconomic impacts, and then translating to the housing market. Leslie, I don't know if that's helpful or even answers your question, but that's how I was thinking about it.
It does. Thank you.
Yeah, we have time for a couple more if anyone else has any questions. All right, last chance. Anybody?
Hey, Mike,
Mm-hmm.
since it seems like our questions might be a little premature, we're probably going to know more in a few months. When is the next forecast meeting?
That will be in September.
Okay. We'll definitely know more by then.
Okay. Well, if no one else has any further questions, well, we'll wrap things up. Thank you all for attending today. Thank you, Luke, for your time and leadership on the committee. And I hope everyone has a great day.
Thank you very
Thanks.
much.